Hey guys, it's the daily market update time. Hope you're enjoying these. I'm enjoying making them, so I'm going to keep doing them for at least the month of December. Today we're going to cover the US jobs report that came out yesterday, a little bit on inflation in Europe, the stock market that continues to fall obviously, and then a little bit on the SEC's decision to put some pressure on China. So right off the bat, obviously the US jobs report is very big news and it's going to dominate this video and most of what you read on the news yesterday and today. Now the headline figures are about 200,000, just over that number for jobs growth in the US over the last month, which was way under the 500,000 jobs growth that we were expecting to see. Unemployment fell to about 4.2%, which is a good number on the surface, but labour force participation rate only rose very slightly and is sitting at about 61-62%, which is still at record lows. There are still 5 million less jobs in the economy than there were pre-pandemic back in, early 2020, and growth of those jobs is starting to slow, which is not great news. So obviously the headline figures are not very good. I would even go so far as to say that they are bad, and the media seems to agree that the headline figures are bad, but the narrative that they're pushing is that the devil is in the details, and the details are much better than the headlines. But I'm afraid I disagree, as I'm sure you're not going to be surprised to hear. Now the reason I disagree is because participation rate, while it did rise a very small amount, I think it was literally 0.1%, it's still historically low and very, very poor. Leisure and hospitality jobs growth stalled completely over the last month, each of them gaining just 20,000 or so. And there are actually fewer retail jobs today than there were 1 month ago, which is obviously, again, a very bad thing. And in my mind, ties in perfectly with this idea of bad consumer sentiment and that people's thoughts and their fears about the economy are starting to come true and they're not feeling happy about it. Again, another detail that the media is putting out as a good thing is that there was a 5% increase in hourly wages year over year. So from last year's November to this year's November, people are earning 5% more on a per hourly basis. But of course, the problem is that inflation is 6% over the last year, even over 6% actually. So real wages are down 1%, which is obviously not a good thing. I don't really understand how any media organization can try to spin that as a positive, but I've seen it done over the last day. Now, some people are seizing this opportunity of bad jobs growth to say that the Fed needs to go back on their newly hawkish ways and go back to being dovish. But again, I'm sure you won't be surprised to hear that I disagree with that. Despite the fact that jobs growth is slowing, the Fed still needs to be hawkish as inflation is just so damn high, and it's one of the reasons that jobs growth is slowing. This policy that the Fed attempted to pursue over the last year of maximum employment has not done us any good, and I'm really glad to see that the Fed seems to be reneging on their ways and going back to treating inflation with the respect it deserves. And to be honest, it seems as though the Fed agrees with me here. They've been spinning this report as good. They've claimed that 200,000 new jobs is still a good thing, even if they missed their target by 300,000 jobs. And they've also been pointing out these other little good figures like 0.1% increase in the participation rate, which again isn't actually that good, but it is still an improvement, and the 5% increase in the hourly wage, which in my mind means that they're trying to spin this bad news as good news in an attempt to justify their hawkish actions in the future, which I think is good news, if that makes sense. Sorry if that's a bit complicated. Basically, the Fed know the news is bad, but they want to pretend it's good so that they can be hawkish and fight inflation, which they know is really bad. Sadly though, while the Fed may have finally got their head out their arse and started to treat inflation seriously, Europe has not done the same thing. Obviously, Europe is seeing higher inflation as well, and they've been seeing that high inflation over the last year as well, but it hasn't been reaching the same levels as the US until this month. Previously, Europe was at 3 or 4% year over year inflation, lagging the US by 3 or 4 months, and never quite reaching the highs that the US did. But over the last month, the inflation rate across Europe as a whole increased to 5%, just over 5% now, and it's basically sitting at the same place where the US was over the last month. In certain places, like in Germany, which is particularly adverse to inflation, Germans hate inflation, they're really fiscally responsible, well, they're seeing 6% inflation as well, just as high as the US, and that is really bad news. In the UK, where I live, the Bank of England, which is our central bank, like our Federal Reserve or European Central Bank, has been more hawkish. They've been warning that they are going to raise interest rates to fight inflation because they see it as such a big risk, and they might even raise rates as early as January or February 2022. The European Central Bank, on the other hand, is very dovish, and they're claiming that there will be not a single rate rise at all in 2022, which is just ridiculously stupid seeing how large their inflation is getting. Now, Lagarde, who is, I think, the president of the ECB, I can't remember her title, but she's the head, she's like the Jerome Powell of Europe, only somehow worse. Well, she's been claiming that it's not possible to compare EU inflation to US inflation, despite the fact Germany's already sitting at 6%. She is literally the Powell of Europe, only she somehow managed to stay arrogant and worse for longer. She's claiming that this inflation is still transitory, that it's still going to disappear, that it's all the fault of supply-side shocks and other countries' policies, and it has nothing to do with the monetary policies that the ECB has pursued. Of course, she's wrong. Now, on these poor jobs reports, the market's dipped again, as you would expect. Omicron is still worrying a lot of people as well, and the VIX, the volatility index, has reached above 30, which is the highest we've seen for most of the year. The markets just aren't in a very happy position, basically. Facebook, or I should say Meta, is now down 20% from its all-time high and looks set to enter an actual bear market. DocuSign, one of those infamous high-growth tech companies that lots of people are very excited about, Cathie Wood especially, dropped 40% overnight on some earnings reports that weren't too good. Basically, anything with loads of promises but no real path to an actual monopoly, companies like Peloton or Zillow or DocuSign, that may be able to grow into solid businesses that generate billions a year in profit, but they're never going to get to the point of Apple or Google or Microsoft where they have ridiculous moats and ridiculous revenues and ridiculous margins. Well, they're going to struggle over the next year and they're probably going to perform very badly. They are priced as though they are the monopolies of the future, but they're just not, and they don't have any real path to that. DocuSign, for example, is basically just a system which makes contracts really easy to use digitally. And I've used them myself, but I've also used their competitors like Signable. And to be honest, I don't see any difference between them. In my mind, their best bet is probably just to get acquired by someone like Microsoft, because if Microsoft comes out with a competitor and pushes it on their systems like Windows 11, then they just have no chance of survival. And the problem is that they're valued as though they are the next big tech company that's going to dominate the world and become a monopoly with price-setting powers and everything that comes with it. In investor news, Charlie Munger came out and said that the bubble that we're in now, the everything bubble, index, crypto, NFTs, whatever else you want to call it, he said it's worse than the 2000.com bubble, which is obviously a pretty big claim. I guess we can add him to the growing list of skeptics of the so-called strong markets and cash accumulators that we're seeing in these times. In China company news, well, the SEC is continuing their crackdown on Chinese companies, and in particular fraudulent companies. Now, the idea behind this is that Chinese companies will be booted off of US exchanges if they don't open up their books to independent auditors and start giving truthful and honest financial reportings. Now, in case you don't know, but you probably do, fraud in China is absolutely rampant. The country is literally famous for intellectual property theft, I'm sure you're all aware, and fraud in companies in China in general is just absolutely rampant, and that's why they don't like to give out information to US exchanges or investors. There's no joke on this topic, and it goes something like this. When looking at a Chinese company, there are 3 sets of books or accounts. One for the CEO's wife, one for the CEO's mistress, and one for the CCP. And the problem is, you never know which one you have. Basically, if Chinese companies continue to act like this to hide their financial dealings and their assets and their debts and everything like that, the US will punish them. Now, this is obviously actually a good thing. Financial regulations are important and they're there for a purpose, and that purpose is basically to weed out bad faith actors, of which lots of companies fit that description. But this also points out another problem with investing in China as a whole, and that is another regulatory risk. You see, a lot of people think that the risk from investing in China comes purely from the VIE structure or from the CCP, but in reality, there's a big risk of Western governments delisting these companies and targeting them as well. I would not be surprised if over the next year, a company like Xpeng is delisted in the US, the share price crashes, and investors get burnt. Then we heard a little bit from another big Chinese fraud, and that is, of course, Tether. Now, they lied about their funds in the past, they've been convicted of lying about their funds, and they pumped the crypto market as well. Well, they recently came out and announced their entire asset holding, and they're holding about $30 billion of commercial papers, but they are refusing to say where it's from or from which companies. Now, the problem here is that there is no independent auditor verifying these claims. This is literally just Tether coming out saying, yeah, we have 30 billion here, 15 billion in treasuries, and 20 billion in cash, and we're just supposed to take them at their word, apparently. The problem is that these Chinese papers are almost definitely from dodgy Chinese companies, and lots of it is also probably from the property sector in China, and within a year, almost all of it will probably be worthless. Obviously, this is a big risk for crypto markets as well. That's pretty much it for today. I hope you enjoyed it. I will hopefully do one tomorrow, even though the market's closed, as long as there's enough news out. I think I'm going to try and do these on the weekend as well, but obviously, if the day's really slow and there's just nothing to talk about, it might be a very short video, or I might not put one out at all. Other than that, Monday to Friday for the entirety of December, just to say thank you to you guys for the awesome support you've given the channel recently. Now, if you enjoyed this video, then leave a like and a comment to bless the YouTube algorithm. If you want more content like this, then check out our Patreon and join our community of investors. You get access to our Discord, loads of exclusive content like private live streams, extra videos, and buy and sell alerts for my own personal portfolio. There's a link in the description to masterworks.io, a site that allows you to buy fractional shares of art from world famous artists like Banksy, which can be a great way to diversify your portfolio with non-market correlated assets. There's also a link in the description to BLOCKFI, which will give you $250 in free Bitcoin when you use it. You can also get 9% interest on stablecoins like USDC, which is a far higher rate than you'll get from any savings account these days. Just be sure not to use USDT. Thank you all for the support. Thanks for watching. Stay stoic. Until next time.